Average guys.
Hello, everybody.
Average Guy Finance.
Yeah.
All right. Sorry, I'm Vic.
I'm Darren.
All right. So today we're talking about my portfolio. We're just going to go through it and just at the key point. Yeah, I think it'll be interesting for people because you can see kind of the context of how I think about investing. And
right.
There'll be context for our future videos and past videos and stuff.
Yeah, because we did a video in the past about stocks that we would totally avoid. We put together a team, the worst team possible we could of stocks that
stocks.
Yeah, and so
a lot of those stocks have been not very good doing very well.
But a lot of people holding those bad stocks are telling us to wait till September. So we're going to wait. We're going to wait till September, and then we're going to talk about those. Yeah. So this would be kind of like a good team of stocks, right?
Yeah. So this is my portfolio. So I have 19 different positions.
19. Okay.
Right now. Okay. So we'll go through those. Okay. So first, guys, everyone. So cash and cash equivalents.
Okay.
So I have some cash on hand, and I do have some short-term bonds, some ultra short-term bonds. So I have 6.8% of my portfolio in cash, basically.
Okay.
So, and that's kind of interesting because it's like, everyone's like kind of like, gung-ho in the market. It's like, don't keep cash. Largely the reason I'm doing this is because I am envisioning buying a house in the future in the next 1 or 2 years.
Okay.
So for that kind of stuff, for your down payment, you want to kind of have, you want to have some money like set aside.
Okay.
But
why couldn't you just sell some of your positions to get that cash to do that?
Because the problem is like I don't know what the market is going to be like a year or two from now, right?
Okay, so like it might be lower.
Yeah. So if the market tanks, I want to like at least hedge my bet and like I at least have the money I need for the down payment set aside, right?
That makes sense.
So then I don't, and it is kind of because it's like, since I put that money into cash, the market has kind of gone up a little bit.
Okay.
So it's kind of like, kind of kicking myself a little bit, but it's like, I know I made the right decision.
Right.
Right. So like, it's kind of like fundamental principles. So it's like, if you don't need the money in the next 5 years, go ahead and put it into stocks and long-term holdings. If you do need the money short-term, you want to have it in something stable. So like.
Okay.
Yeah.
Okay.
So cash or ultra short-term bonds.
Okay.
Yeah.
All right.
Okay. So next is my holding in the S&P 500.
Okay.
So I have 12.9% in the S&P 500. So the S&P 500, the top 500 companies in the U.S.
Yeah.
Pretty standard investment.
So me asking a question here, how would you hold the S&P 500? So would that be an index fund?
Yeah.
Okay.
So like an ETF, so an exchange-traded fund.
Gotcha.
So that's traded just like you would trade your stocks and stuff with your broker. So some of the index I use iShares. So that would be like for us in Canada, it would be like XSP, XUS. It could be VOO in the US. That's like the Vanguard S&P 500. So there's a lot of companies that help you track the S&P 500. If you buy any of those exchange-traded funds, you're basically getting the return of the S&P 500.
Now I noticed that my banking institution was kind of like it's almost like they want me to buy some of those because last month they listed a bunch that have no fees attached to them that you can buy. So that's pretty nice too. Save yourself $10 every time.
Yes, that's really good because I used to like save up money in order to buy into in index funds, but now it's kind of nice because it's free. So and a lot of other companies offer free for free now. It's pretty standard, and the banks are now getting into it. But it is nice was if you have like $500 laying around, boom, just buy, put it into the S&P 500, that kind of stuff.
Yeah.
Okay.
There you go. Okay.
So my second ETF I have is ZEM, ZEM, and that's a Bank of Montreal ETF that they manage, and it tracks the emerging markets.
Okay.
So the emerging markets.
Well, yeah. What would those be?
Those are like mostly the BRIC countries. So you've heard like the BRIC.
The BRIC countries? I don't know that
in terms of the term. So that stands for Brazil, Russia.
Oh, okay. It's an acronym.
India, China, Korea.
Okay. Yeah, brick.
So those kind of countries, you can throw like maybe South Africa in there, maybe like Saudi Arabia,
right.
Potentially. So, but they invest in those kind of countries, those emerging markets. So I'm interested in that. And I have 4.4% in that. I am looking at increasing that, and maybe even getting into some individual stocks in China. That I'm like Alibaba and JD.com and Tencent.
Now, what would you say to somebody who's like a nationalist who's going to say, I ain't going to buy those stocks because you're a trader if you're investing in Russia and China and what are you going to say to those people?
The globe is pretty linked, so it's like you can think whatever you want, but the leaders of all the countries, they have like a pretty globalist mindset. There is global trade. There is a parts of the world that I think are going to see huge economic growth. That's going to be in China and India and Brazil. There's a large middle class growing.
Yes.
And also there's like there's a young demographic. So
large middle class, young demographic. That means lots of disposable income. That means they're going to be buying lots of things and just going out and
and they're going to be working and producing and being
I ain't buying none of those things.
Right. Okay, so let's. So those were the cash and the ETFs. Let's go into individual stocks.
Okay.
The fun stuff, right?
Yes.
So my biggest holding. So like I put this into like sectors, but so one sector I looked at was diversified assets. So kind of like asset managers. So these are companies, I would say like Berkshire, managed by Warren Buffett here.
And his pal Charlie Munger.
Yes.
Right? Yeah.
So Berkshire, basically they own companies, they own parts of companies, and they invest in assets and that kind of stuff. So they're just very diversified across different sectors and industries and asset classes. And they're just a very, very good vehicle for investing in and growing your money.
Right.
Yeah, and the nice thing is like when you buy them, like there is no management fee. Because a lot of times with mutual funds, you might be paying as much as like 2% management fee, right?
Right.
These guys, if you buy their stock, are going to manage your money for free.
Right.
And they're going to give you very good returns.
Yeah.
like above average market returns historically. So and a very solid business base right now, right?
Yes.
So.
Yeah, they're basically invested in everything that everybody uses, right, on a daily basis.
Guys,
it's just solid, and paint, and insurance, big insurance, insurance,
lots of
Apple too. Yeah. Okay. Yeah.
So that's so I have 8.3% in Berkshire, and then I have 3.8% in Brookfield.
Okay.
So Brookfield is kind of like a Canadian Berkshire.
Okay.
So they own assets. They own assets all around the world. They own different companies and that kind of stuff. So it's just it's an easy way to get diversification, but maybe some targeted growth. Whereas like you have people like look very expert people in their field, looking at good investment opportunities, and they're especially Brookfield. They're very aggressive in buying undervalued companies, or companies that are kind of in trouble, and then like rehabilitate, like rehabbing them.
Okay.
So it's So that's I would actually like to increase my holding of Brookfield. They're a company that I like a lot, but I have 3.8%.
Okay.
Okay.
Yeah.
So that's like a diversified sector. Let's look at banking.
Banking. So banking is what I'm going to go hard on over the next 6 months. Between now and the end of the year, it's July now. Okay, go ahead. Yeah.
So banking is one where you hear a lot like these Kathy Wood and like ARK Invest people and her team and people who like her. They look at banks and they say like, oh, it's just a value trap.
What? Okay. What do they mean by that?
Well, it's just that they just like make money, but there's like not a lot of growth, or it's like they seem to think like, oh, they say all the company does is just like make money. It's kind of boring, right? There's not like innovation, but it's like what's the problem with that?
I don't understand.
I don't understand.
If I'm investing in a company, all I wanted to do is make money.
Yeah, and there is like innovation at the banks because they do come up with different products and different ways of delivering the products, and like online banking has been huge innovation, right?
Yes.
The way we bank has been completely changing.
Yes, the way we bank, the way we buy stocks, the way we do.
Yeah, and I think they'll probably be into the cryptocurrency kind of thing too.
Yeah, it's going to happen eventually.
I don't know what's really going to happen with cryptocurrency, but anyway, but like, I think they'll be taking advantage of that as well. So it's like banks. I think they are innovative companies, and they're very good at making money. So I don't see why you wouldn't want to invest in them.
Right. Yeah. There was something that you said last week that really blew my mind that I had never really thought about before. Where did you hear it from? From Mr. Singh. What's his first name?
Mr. Singh?
Yeah. He said, why would you open a savings account with a bank that pays you point whatever?
Oh, Jaspreet Singh.
Jaspreet Singh. Like why?
From the minority mindset. Yeah.
Yeah. Why would you put your money into a savings account with a bank that pays you 2% interest?
Yeah.
When you could buy stock in the bank that pays you what kind of a dividend?
Like 4%, 5%.
Yeah. Isn't that amazing? That blew my mind. So that's why.
Yeah. And you're getting price appreciation. Yeah. So it's like, you'd much rather own stock in the bank than just give the bank your money to like do with what they want with.
Right.
Without really giving you much in return, right? And so for my banks, I own 3 Canadian banks. So I own RBC, that's Royal Bank of Canada, and that's at 7.8%.
Okay.
BMO, Bank of Montreal, so I got them at 5.3%.
Okay.
And TD, that's Toronto Dominion Bank, at 5.1%.
5.1. Okay.
Yeah. So you're going to be basically trying to buy all the Canadian banks, like over the next 6 months and stuff.
Yes,
right?
yeah. I'm going to start with RBC. RBC's the biggest, right?
Yep.
And then is it the National Bank that's second, or is it TD? TD, and then
Scotia, BMO, CIBC, and National is the 6th.
Oh wow, okay. I didn't know National was so low. Okay.
Yeah. Well, there's the Bank of Canada.
Right,
and then
that's
there's National Bank.
That's what I
so there's like 2 different things. Yeah. So Bank of Canada is kind of like the Fed.
Okay.
Yeah, so that's banking, and I think I have something like 18% of my money
in total
in the banking sector.
Yeah.
Like directly into banks. I think that's okay. Yeah, that's pretty good. And they give me like really solid dividends and growing dividends, and it's a good place to be.
Yeah.
Yeah. So
there's always going to be people with mortgages. There's always going to be people with lines of credit. There's always going to be people, right?
Yeah.
I mean, if you were cynical, you might say that one of the ways that banks are most innovative is keeping people in debt and making it possible for people to stay in more debt. But I mean, if that's just human nature and that's the way most people are, that they are going to be in debt, why not?
Yeah.
Take a little.
And I guess. Yeah. So the bank collects a lot of interest from a lot of people who are using debt and stuff, and I like it when the bank pays me.
Right.
So maybe I will use debt in the future, but I do like a lot of some money coming back from the banking sector too, right?
Yeah.
So that's a good feeling.
We'll do a separate video just on dividends, like another day.
Yep. Yeah. Cool. All right. So next sector is real estate.
Okay.
Okay. So real estate's. It's an interesting sector because it's like I think it's one thing because it's like. It's good because it's not a commodity that's going to go away. It's if you look at like real estate, if you're investing in real estate companies, it's going to be very hard for those companies to go completely bankrupt.
Right.
Right. It's because it's like.
Now, when you're talking about real estate, you're talking about property management companies, right? Like companies that own apartment buildings, companies that own office buildings. Yeah.
So we'll go through like the ones that I have in my profile. So we have a RioCan at 8.3%. So RioCan's more of a commercial, like retail REIT.
Yeah.
So they traditionally had like a lot of like shopping malls and that kind of stuff.
Yeah, they have a mall right next door to us over here.
Yeah. And then so my second holding at 7.5% is CAP REIT, which is the Canadian Apartment REIT. So they basically do apartment rentals.
Okay.
So say I got them for 7.5%. And my last one is an office REIT. Allied REIT at 5.6%.
Okay.
So they all specialize in offices. So it's like I got one from each different area, right?
Yeah.
Yeah.
You've got everything covered, all your bases covered.
But what's interesting though is like all these companies, they are interested in growing and like growing their portfolio, like increasing the properties they have, but also building up their properties.
Right.
Right. So RioCan next door to us, like that's a huge. You can see it from our windows. It's like absolutely a massive lot, right? But it's kind of like the space is not really used efficiently,
right,
as well as it could be, right? So now when they have when they come in and they have like residential towers going all over the place, and they have underground parking, and they have the retail also in there as well, and maybe some office, like you're kind of like you're creating communities. Right in there, and then there'll be communities, kind of like sub-communities around those kind of like RioCan developments that arise, right? So I think there's a lot of excitement there because it's like you're not just collecting those steady dividends. So what's interesting about REITs, like real estate, is that you're getting the dividends every single month. So that's really nice because I like to see the income coming in every single month. It kind of gives me like positive reinforcement.
Yeah.
So
that's why when I first started investing in the market, you had me in a couple of So I could it makes a huge difference when you see the dividends coming in every month.
Psychologically, So you're getting the dividends, but you're also like with these companies, you're getting value growth. Like these companies are going to be worth more because their land is going to be worth more.
Right.
Not only because it's just passage of time, just land just becomes worth more.
Yeah.
They're also developing their properties, which is really exciting.
Okay.
Okay. So now, just imagine the all the different more use that building is going to get.
Yeah.
Right. So
it's not just the building, the space around it too, right?
It's exciting to be around, for sure. So moving on. So the next sector, we've got railroads.
Okay, railroads.
Okay. So railroads are interesting in Canada. So for Canada, so in my portfolio, we have CP Rail, that's Canadian Pacific Railway, at 6.7%. And we have CN Rail, it's Canadian National Railway, at 3.2%.
Okay.
So those are the two major railways in Canada, and I've decided to have a stake in both of them.
Yeah, those are the only two railways in Canada, right?
There might be some sub ones, but those are definitely the major ones.
Okay.
The Class 1.
Okay.
And then there's I think 5 Class 1 railways in the U.S.
Okay. And railways are important because everything that we consume has to be moved by rail, right?
Yeah, transportation is important, and rail, there just hasn't been anything that's come close to replacing rail. Like the efficiency and and it's actually very environmentally friendly because for the tonnage that they're hauling, they're using relatively few fossil fuels and energy, right, compared to like trucking them all and stuff like that. And they're also getting better because like CP Rail, they're coming out with they want to use hydrogen powered trains.
Oh, nice.
So they'll cut down on fossil fuels even more, right? But it's like it's so critical to the overall economy and the Canadian economy as well, right? So it's like there's like such an important need for this industry. And there's only like 2 major players, and it's very difficult to get into this industry. So they have a wide moat.
Yes.
So it's very so investing in this sector. So I have roughly 10% of my money in railroads. Okay. I feel pretty confident with that because it's like I know it's an industry that's going to be there. It's very important. Yeah.
And because they've been around for so long, they're also, I don't know if this is good or bad, but because they've been around for so long, they're probably sort of entrenched in government too. They're working very closely with government to.
I think you see that with a lot of Canadian companies. Yeah. Well, I guess like Chinese companies too, and probably American companies. Like there's a lot of. We're not so like free market as you think, but whatever, it is what it is.
It is what it is.
Yeah. All right, guys. Okay, so next week we got the telecom sector.
Right.
Okay, so telecom is communications, and that's
cell phones.
That's a big thing because
internet.
Because like cell phones and internet would basically become mandatory. So it's not just like phones anymore. Phones are like passé.
Right.
Like I said, it's like It's cable. I guess cable is kind of like passe 2 a little bit, right?
Yeah, it's getting there.
Yeah, but like with the telecoms, just the importance of cell phones and internet is because you can't go without Wi-Fi.
No,
right?
not really.
Yeah.
Yeah.
Okay, so I got Rogers Communication at 2.9%.
Okay.
And I got Lumen at 2.2%.
Okay. Now, why did you choose Rogers and not Bell?
I could choose Bell.
Okay.
Like, so I could have some Bell, but
there was no allegiance to the Toronto Blue Jays and Toronto FC, and
so Rogers. So Bell owns parts of the Toronto Maple Leafs and the Raptors and TFC. They also own parts. And then Rogers owns parts of those teams as well. Okay. And Rogers also exclusively owns the Blue Jays.
The Blue Jays.
So. It's my favorite team is the Blue Jays, so it's kind of a neat thing to be a shareholder of your team, right? So that's a neat thing. Not really the reason why I bought it, but the other thing is that there's basically 3 major players in Canada in terms of at telecoms.
Who is it? Rogers, Bell, and who's the third?
And TELUS.
Oh, okay.
And the fourth was Shaw, which with Freedom Mobile, which was that's how I got my cell service. So now Rogers and Shaw agreed to merge this year. So it looks like Rogers going to probably get a bigger market share of the market. Their revenue is going to go up, and probably their share price is going to go up. So that makes sense.
Did you buy Rogers after they merged with Shaw?
Yes.
Okay. Yeah. All right. That's a good move.
So the second one is a U.S. company, and it's called Lumen.
Okay, now that was my big tip to you, right?
So I got this idea from Darren, and I looked it up and researched, and I was like,
Darren's not stupid. Darren knows what he's talking about. I
was questionable about it because I was like, I'm gonna dive deep into this, but I was like, okay.
Darren makes bad decisions.
But I was like, okay, so Lumen used to be called CenturyLink, and they used to be kind of more of an old school provider, like a DSL internet, landlines, that kind of stuff. Okay. Now they're more into data centers. Okay. Right. And then they have a huge a fiber optic network. So that's probably their biggest asset. And what they want to get into now is that they want to get into the next generation of telecommunications. Okay. So they want to be that company that we can be sitting here and we can be zooming into a retail store and having a customer, like a real life customer experience. Yeah. From our house. So it's almost like a virtual reality type of thing. So you can put on a set of goggles and go into the Gap and I'm not sure how they'll do it. I guess goggles would make sense, but or maybe you'll just see it in your screen. I'm not sure exactly how they will do it. Right. But I define them more into that. Like what their plans are and what they're getting at. But they spent a lot of money and to basically transition their company into this. So it's not a guarantee that this is going to work, but I think if it does work, I think that there's going to be very good growth opportunities. Yeah. The other nice thing about Lumen is that they pay about a 7% dividend. 7% dividend. Holy so smokes, it's so while you're waiting for them, they're still getting a lot of revenue because they still have millions of customers over multiple countries. Right. So they still have a large customer base, right? So those are my 2 telecom picks. There's other ones. Those are pretty solid. You don't have any other ones, though? No. Those are the telecom sector, right? Okay. So I've got about a little over 5% in the telecom sector. Okay. Okay. Yeah. Okay. So our last sector that we're looking at is not really a sector, but it's probably the most interesting or exciting sector. It's a sector of growth companies or companies or stocks that I think are going to grow in the near future, more kind of speculative kind of companies, right? Okay. So out of your entire portfolio, these would be your biggest risk stocks, but they're really not that risky because they're pretty. Yeah, probably not. But these are probably the ones that I'm going to keep an eye on a little bit more. And these are probably hopefully the ones that we will go through them. But there's kind of different type of companies here, right? Okay. So we'll discuss. Okay. So. The first one is Air Canada, so that's 4.3%. So Air Canada is kind of like a rehab project, right? So with the pandemic, air travel has been basically, pretty much at a standstill, right?
Yeah.
Especially in Canada, we're being very cautious about allowing travelers in and everything like that. It's had a huge impact on the airline industry, on the Air Canada itself, and Air Canada stock. So basically, I was able to buy Air Canada stock for like a huge
why don't we tell
discount.
people what was Air Canada stock at before the pandemic hit?
Above $50.
And what was it? What did it drop to?
$15.
$15, yeah. And you bought it around where?
I started buying like 20, and then when it kept going down, I bought a little bit more. But it's like and the government, the federal government here, put money into Air Canada.
Right.
So it's like the stock and the company is going to stick around, especially there's government incentive for make sure it sticks around. It's just like a recovery play, right?
Yeah.
So it's like people get nervous.
We're only sorry, go ahead. Yeah.
Yeah, well, but people get nervous when things. Well, there's like a global pandemic, but it's if you kind of relax a little bit, and then you can find these kind of opportunities when these.
Well, I mean, I think
happen,
that's a
right?
pretty glaring opportunity because we're not even open yet. Like the country and travel isn't even open yet. So by the fall, I can see that going to like $35-$40 a share, right?
Yeah, you have to be patient with these kind of things.
Yeah,
but
it's definitely going to get back to where it was.
So the second stock in my sector here, the fund growth sector, is Aritzia.
Aritzia, what do they do?
So Aritzia
Bread,
is
pasta?
Women's clothing.
Oh my God. Okay.
So Aritzia, it's a Canadian company. They were started in Vancouver in British Columbia in 1983. So interestingly, when I was born. So this is a company that's been around for a while, and they went public in the 90s, or the early 2000s, right?
Okay. Wait, when did they start?
1983.
And they went public when?
Late 90s, early 2000s.
So that's
They've had a while to like grow before they went on the stock
Not
market.
like some of these companies that are
not like Lordstown, where it's like we were not making anything, but we think we should be on the stock market.
They're not being brought to market via SPAC. They've earned the right to be there, right?
So I got Aritzia at 2.1% of my portfolio.
Okay.
And they're an interesting company because so they're a women's apparel company. That's their biggest market. They have an interesting strategy because in the pandemic, they actually did really very well because their strategy is to focus more on online sales. Okay. And they have retail locations, like physical retail locations, but they're more there for brand marketing rather than like a retail presence, right?
Right.
So they're more for like, having a presence, getting the word out there, people seeing it, and also having their boutiques in strategic spots, like strategic malls and cities and that kind of stuff.
Yes, okay.
And
I guess
you get like customer experience from the
I guess if you have a return, you can go there and do that. Although people are more comfortable doing mail returns now, but if you're not comfortable doing that, you can just go to the store and do an exchange. And,
So with their online sales, they've been doing really well from the pandemic, and they also have an interesting marketing scheme where they hire YouTube promoters, like influencers, like Instagram and that kind of stuff. So there are YouTube clips where you see these girls promoting Aritzia. It's like, I went to Aritzia, and this is what I bought, yada yada yada.
Yeah,
those kind of videos, right? So it's interesting because it's like it's much more engaging kind of advertising, and it's different from the mainstream, more traditional advertising where you just have these expensive 30-minute or 30-second clips, right, that nobody really pays attention to, right? But like a YouTube video, like an influencer, you get more engagement. Yeah, and also you get more repeat customers and
you can target those ads, right? You can get them right to the people who are going to buy your product. So that's good.
So it's like I really like just the way they do their business, and the company's doing really well. And now they're branching into men's clothing as well, like men's athletic wear and stuff. Okay. So it's a company that's growing and doing really well. Yeah.
Good. Okay.
Okay. So we got the third holding in the growth kind of sector, HMMJ.
Okay, and
that's an ETF. That's an exchange traded fund that tracks the cannabis industry.
Okay, all right. Canada. It's a weed stock. Yeah. Okay.
Well, it's a weed ETF. Yeah. So it's not one cannabis or weed company. it's all of them, like the entire sector, right?
I see.
So it's like that's really good because so cannabis, it's a growing and emerging industry. It's kind of volatile, but there definitely seems to be a lot of interest in it, right? And there's like some growth potential, and I mean it's hard not to make money selling weed, right?
Right.
So it's but instead of like relying on or investing in one single company in this kind of industry, because like it's a new industry, so you don't know which companies are gonna like make it.
Yeah.
Like which companies are gonna be like those solid, generational kind of companies.
Right. Which you don't know which cannabis company is going to become the Coca-Cola and the Pepsi, right?
Yeah.
It's hard to tell that, so that's a safer bet.
But buying the ETF that tracks the entire sector, you're gonna just track the growth of the industry as a whole, and also like a lot. So there's maybe like 25, 30 companies in this ETF. When there's like potentially inevitably there's going to be mergers and acquisitions, and those smaller companies are just going to get absorbed into the larger companies,
right.
But the fund's just going to like grow. So it's like you're going to get all those like gains from the mergers and acquisitions and stuff like that. So it's just like a good way to. So I bought this stock right in March 2020.
Okay.
Like right when the market like.
Okay.
Crashed.
So what did you buy it at? Do you remember?
Less than $5.
Okay.
It was like 4 something or yeah. And then it just kept going up, and I bought a little bit more, and there was a time where there's kind of like a craze. It went like kind of.
It was like up over 25 or something around there, right?
19.
Okay.
I sold half of it at about 11.
Okay.
So it's like because I basically said like, look, I made all this gain in like 2 months. I'm gonna like sell half of it, and then it just kept going up, right? I was kind of kicking myself, but I'm like, look, I made the right decision, and then it went to 19, and then it just like it's gone back down,
right?
So it was like a kind of hovering around 11, like where I sold half of it, and then it's gone down a little bit since then. But
do you know where it is at now?
It's in the 9s.
Okay.
So like a 9s, kind of 10s, but
I see.
But I think when more U.S. states start legalizing.
New York is almost there, right?
Yeah, and it just basically it's just becoming inevitable. And this is another one where you just have to be a little bit patient. And I think it's gonna like.
It's long term. You're looking long term with that. Yeah.
So the 4th stock is Peloton.
Peloton. Yeah.
So this is my smallest stock. I only have 0.4% of the portfolio in this.
Okay. Now, why did you buy Peloton?
So Peloton, I bought it at $83. So this was one that we were discussing for a while, right? And we were tracking the stock. So this is an interesting thing because we were tracking the stock, and it was around, like it went as high as like $170, like $175.
When was it at 175?
Like earlier on, right?
Oh, yeah.
And then it's when we like January, February of this year, when we saw a lot of tech stocks and like these high kind of. There was like a rotation away from like kind of the COVID stocks, the pandemic stocks, away like into these more like reopening stocks.
Right.
So and Peloton fell from like $175, and it was like kind of hovering around like $120, $110, $100 or so, right? And it was kind of like there.
Yeah, it just seemed like it was trying each day to get up over 100 and stay there.
But we always were kind of interested in it because like we were just like I was like for me, like even before this year, I listened to a podcast, and these 2 women in their early 30s in New York, and they have like a health and wellness kind of podcast, lifestyle kind of podcast, and it does really well. Yeah. But like they absolutely love Peloton.
Oh, okay.
And like they know like a lot of other, women in their demographic and age and everything. Yeah. They love their Peloton, and like and I was like, okay, well, this is interesting because it's like, you can see these companies and they're kind of becoming like very like household kind of names. Yeah. And almost kind of like a
Peloton is the verb now, right? Like, or the is that right? Like you don't say a cotton swab, you say a Q-tip, right? Yeah, the noun.
I guess it could be because you could be Pelotoning.
I'm gonna go Peloton. You're gonna Peloton this evening.
But it's like a Peloton. What a Peloton is, I discovered. A Peloton is just a group of bikers. That's a Peloton.
Okay.
Yeah, and they describe it in like Tour de France or something.
Oh,
right?
okay. I didn't
So
know that. I just thought that was the name of the person who started the company.
No,
I didn't know that.
Yeah. So, but it's becoming like that kind of thing where it's like it's not tissue, it's Kleenex.
Right.
So it's not just a bike. It's Peloton.
It's a Peloton.
And I remember you showing me a condo advertisement.
Yes.
For like you can buy a condo, and they're like, and in the advertisement I saw that yes, and there's like this, and this, and this, and there's space for your Peloton.
Right.
So I was like, oh, this is interesting. Now it's becoming like a very household kind of name. So then they had this story where they had this recall because they branched out into treadmills, and the treadmills turns out were kind of dangerous.
Well, all treadmills are dangerous. You have to keep your kids off of them. You know?
So there was tragically, there was a child that died off of a Peloton treadmill. There's the stories between pets getting sucked into like underneath the treadmill and that kind of stuff. So they kind of resisted recalling it, and I called it out. I said that's not a good strategy, right? They should have. So then they went, okay, we're gonna do the recall, and their stock did take a hit, and it went to $83.
Okay.
So I remember that, and I was like, okay, I'm gonna buy it, but I should have bought more because I was like. So I only bought like a little bit because I was still like unsure about it because it's like a new company and stuff. Yeah. But then I was like, okay. But I was like, when like you have bad news and this kind of stuff, and I knew that treadmills are like a really small segment of their business, right? It's the bike that matters. But I thought, okay, they're going to get some goodwill by getting this recall, saying, okay, you're going to get a refund and yada, yada, yada. Yeah. And then they'll recover from this.
Oh, of course.
And the stock has recovered.
And they did, the stock is doing very nicely now. Yeah,
so if you, all those bad news, like buying the dips kind of thing. So I guess, if you're following a company like this and you're looking for a moment to get in and...
that would have been it.
Yeah, this kind of happens.
It probably still is right now. It's a good time to buy it because like all of these subscription-based companies are really, really good, right? Like Netflix is.
Because you got to think about what is the potential 5-10 years.
Yeah.
And what kind of growth, especially when they grow into like overseas and So and then when they become like much more like a mainstream and everything like that. Right. So. Yeah, I mean, you're looking at you don't want to look at stocks like too short term, but you're looking at companies that could grow in 5, 10, 15 years.
Yes. Yeah. You want household names, things that everyone's just going to have.
So guys, that's basically my investment portfolio.
And roughly how is your portfolio doing like over the last 3 years compared to what the S&P 500 has
a few percentage points above the S&P 500 over the last 3 years.
Right.
Recently, like much more higher than the S&P. But that's just because I think just with the pandemic, I took advantage. I just bought stuff that was at like huge discounts, like BMO and Bank of Montreal. Like getting those kind of stocks. I
had somebody say to me that when. During market crashes or any kind of downturn, whenever you see bank stocks drop, she told me that she would. This was a financial person who was managing a fund for, I think it was for TD, but she told me that she would use her lines of credit to buy bank stocks whenever she saw them down, and then you can write the interest off on that. I didn't know that you could do that. That's interesting. That's good, right? Yeah. And then she would wait for them to go back up and then sell what she needed to put back.
It's good strategy.
Good. But
so I think like this is. Like I guess like the point I'm making this video is like saying like it's like I think it's like a very solid, well diversified portfolio. The S&P 500 is my biggest ETF at about 13%, but I don't have anything else above 10%.
Okay.
And I have and a lot of the stocks that like kind of like are a little bit iffy. They're smaller portions of my they're around 2-3%, and so it's like you don't. I think this is like a portfolio, like, don't go copy my portfolio, but it's like, I guess like you give some context on like what I think, is like a good steady portfolio for like good steady returns.
It's a broad section of business.
You don't have to like go for that home run swing on that one company that doesn't make any revenue, but you're thinking, as soon as they get some sales,
like some of the people are doing with Lordstown Motors.
Yeah, and a lot of these stocks they pay just a steady dividend. So it's like,
isn't that nice just seeing money coming in every month, every quarter?
Some money every. You're gonna, as an investor, you're going to get a return right away. Right. You don't have to wait and hope.
There you go.
Yeah.
Okay.
Good.
That was Vick's portfolio.
All right. Yeah. Thanks for tuning in, guys.
Okay. Thank you. We'll see you next time.